Hello students, welcome to the home schools. I am Mr. Sharan here. In this video, we are going to discuss about the meaning and features of accounting. We already know that accounting is a very important subject to understand for every commerce students. I can say that accountancy is a core subject. Without accounts, there is no existence of the commerce, because for every commercial transactions, or we can say for every business transaction, we need to maintain the accounts. So in this series of videos of accountancy subject, we are going to discuss about from the basics of accounting, that is from the meaning of accounting up to how to prepare a financial statement for a sole proprietorship, how to prepare a financial statement for a partnership, and how we are going to prepare a company accounts. Everything we are going to discuss in this accountancy series of videos. So as a part of that, today we are going to discuss about the meaning of accounting as well as what all the features of accounting. Okay, so accounting, we can say, it is not a one-time job. It is a continuous process. You please remember this. Accounting is not a one-time job. It is a continuous processing. I mean to say that from the date of the starting of the business up to winding up of the business. Winding up of the business means closing down of the business. You need to maintain accounts. That may be 1 year. That may be 2 years, that may be 10 years, that may be 50 years, even that may be century also. Okay, so how many years your business will exist? So many years you have to maintain the accounts. To maintain the accounts, we should know about the transactions first. Remember, accounting is a process which interlinked with the one step to other step. I can say, if you remember or if you know how to make a business transactions, how to identify the business transaction, then from the business transaction we can prepare a journal entries. From the preparation of a journal entries, you can prepare a ledger account. From the preparation of a ledger account, you can prepare a trial balance. From the trial balance, you can prepare a trading account. From the trading account, you can prepare a profit and loss account. From the profit and loss account, you can prepare the balance sheet. So all these are interlinked. If you are not able to understand any one point in between this, you cannot make a final accounts. Okay. So I request you all to please watch the video completely and all the videos, because one video is interlinked with the other one. Okay. So now let us come back to the concept. Meaning of accounting. Remember, meaning is very simple. Accounting is a process of these points: identifying, measuring, recording, classifying, and summarizing the business transactions. Summarizing the business transaction and analysis and interpretation of the result of the business transaction. Analysis and interpretation of the result of a business transaction, and then we need to communicate to the end users. So this is the accounting. Accounting is a process of identifying, measuring, recording, classifying, and summarizing the business transactions and analysis and interpretation of the result of a business transaction. Then we need to communicate to the end users. So this is the meaning of accounting. It is a process. Okay, so it has a different 7 steps. If any one step of this is missing, then accounting cannot complete. So first step is what? Identifying. So I have written a small sentence here. Identifying means determining the business transaction to record in the books of accounts. So what is a books of accounts? Books of accounts means every day what is the business transactions we are making that we have to enter in the books of accounts. Remember, all the transactions must be entered because a business cannot make only one or two transactions every day. It can even make 100 or 200 transactions. It is very difficult to remember all the transactions orally. So, every transactions we need to enter. So, where we are going to enter the transactions, that is a books of accounts. Okay, sorry. So, determining the business transaction. Determining means finding, or we can say identifying the business transaction. Tell me the transaction. Transaction means, in simple words I can say, exchange of a goods or services with respect to the money. That is a transactions. Exchange of a goods or a services with respect to the money is a transaction. Example, assume that I have a car. You wanted to buy a pre-owned car, that is a second-hand car. What you will do? You will approach to me. Okay, so we both will sit together and come with the final price. Okay, I told the car value is a 3 lakh rupees and you were telling that it is for 2 lakh rupees. Finally, we exchanged the car for 2,40,000 rupees. I am exchanging the goods, means I am giving a car to you and instead of a car, you are paying the money back to me, 2,40,000. So, this is exchange of a goods. This is here exchange of a car with respect to the money. That is a transaction. But there is a slight difference between a transaction and a business transaction. Business transaction means exchange of a goods or services with respect to the money in the business itself. Continue the previous example. You bought a car from me, not for business purpose, for your personal use. For the personal use, the transactions what you will make, those transactions we are not entering in the books of accounts. Those transactions we are not at all entering in the books of accounts. We are entering only the business transaction. Business transaction. Business transaction means, assume that you have one shop or one business. Now, what all you will buy for to make a business and what all you will sell to make a business. That is a business transaction. Say an example that you have one hardware shop. Means you are the dealer of a paint. You will buy the paint from the different companies. You will buy the paints from Asian Paints. You will buy the paint from Nerolac. You will buy the paint from Berger. Okay, all these companies are going to sell the paints to you. You are purchasing the paint from them and you are paying the money to them. So it is a business transaction. Why this is called a business transaction? Because you are not buying the paint for your personal purpose. You are buying the paints from the company to sell it to the customers. This is a business transaction. You are buying the paints and you are paying them. So after buying the paint, what you will do? You will not keep it with yourself. You will sell it to the customers. So here you are selling the paints to the customers and receiving the money. From the companies, you are purchasing, paying them. To the customers, you are selling and receiving the money from them. So that is a business transactions. So first step of accounting is identifying. We need to identify the only business transaction to record in the books of accounts. Okay, so along with the business transaction, even we will make some personal transactions. Those personal transactions we will not enter. So continue with the same example. You have a paint shop, but you wanted to buy a car for your personal use. That is not a business transaction. That is a personal transaction. So those personal transactions will not be entered in the books of accounts. We are going to enter only the business transactions. That is the first step of accounting. That is identifying. Second step of accounting, we have this measuring. So to understand this point called measuring, we should understand expressing the value of a transactions. Second step of accounting process is measuring. Measuring is a expressing the value of a transaction in terms of money. This is very important, money, because in the accounting, everything we are going to express in terms of money itself. Everything we are going to express in terms of money. Continue the same example. You bought 10 units of paints from the Asian Paints, 10 units of the paints from the Nerolac, and 10 units of the paints from the Berger. Total you bought the 30 units, and per unit you are paying 1,000 rupees. Total it will be around 30,000 rupees now. Now that is a business transaction, because you are buying the paints to resell it. You are buying the paints from the companies to resell it. That is a business transaction. We need to enter this. But while entering, what to enter? Should we enter that I bought a 10 units from the Asian Paints, 10 units from the Nerolac, and 10 units from the Berger? No. We should not enter as a 10 units. We have to enter as a how much worth money. So 1 unit costing 1,000 rupees. Total we bought a 30 units. 10 units, 10 units, 10 units. It means you are purchased 10,000 worth of the goods from the Nerolac. You purchased 10,000 worth of the goods from the Asian Paints. You purchased 10,000 worth of the goods from the... So like this, while entering in the business transactions, we need to enter in terms of money itself. Instead of entering purchased 10 units, we have to enter purchased 10 units worth of rupees 10,000. This is very important. Expressing the value of a transaction in terms of money. That is the second step. First step of accounting was identifying. Here we are going to identify what all the business transaction we need to enter in the books of accounts. Second step is measuring. So here we are going to measure the value of a transaction in terms of money itself, not in terms of the physical units, not in terms of a qualitative units. Everything we are going to measure in terms of a money. That is very much important. Then the third point is recording. So recording says that here recording the transaction in journal or a subsidiary books. Here we have two words to understand, very important: journal and a subsidiary book. Journal means it is called as a principal book of accounting. Journal book, original book of accounting, because every business transactions we are going to record in this book. In the future classes, we are going to understand how to prepare the journal entries. That is, we are going to discuss in the future classes. But as of now, you just understand journal means it is a original book of accounts where all the business transactions are recorded. If you buy the goods, we are going to record. If you sell the goods, we are going to record. If you receive the money, we are going to record. If you pay the money, we are going to record. Every business transaction has to be recorded. So where we will record? In the journal book. Then we have a second word to understand is subsidiary book. Subsidiary book means simple. We have a total 5 to 6 subsidiary books. We have a purchase book. We have a sales book. We have a purchase return book. We have a sales return book. We have a cash book, and we have a journal proper. These are all the 6 subsidiary books. Now, first subsidiary book was what? Purchase book. In this purchase book, we are going to enter all the purchases. Credit purchases. What is a credit purchases? Credit purchases means we are purchasing the goods now, but we are not paying the amount now itself. We are paying the amount in the future date. That is a credit purchases. So those type of the credit purchases we are going to enter in the purchase book. Then purchase return book. Purchase return book means we already purchased some goods. In that, because of some reason, because of a damage, because of not using those products, we will resend them back. So that is a purchase return book. All those purchase return transactions we are going to enter in the purchase return book. Third one, we do have a sales book. Here all the credit sales. What is a credit? Credit means payment or receipt of money happens in the future date. Credit sales means we are selling the goods now, but immediately we are not receiving the cash. So we are receiving the cash in the future date. Those are all called it as a credit sales. Those credit sales we are going to enter in the sales book. In the subsidiary book, purchase book we have, purchase return book we have, sales book we have, and the fourth one we have a sales return book. Sales return book means it is simple. We already sold the goods. Because of some reason, customer given us back. Okay, so sales return. So those type of the sales return we are going to enter in the sales return book. And the fifth one we have a cash book. Cash book means all the cash transactions. So in the business transaction, mainly we have a two type of the transactions. Okay, so in detail we are going to discuss in the next videos. Transactions, mainly we have a two type of the transaction. We have a cash transaction and we have a credit transaction. Cash transaction means exchange of the money happens immediately. If I buy the goods, I will pay the cash immediately. If I sell the goods, I will receive the cash immediately. That is a cash transaction. Credit transaction means if I buy the goods, I will pay the money in the future date. Or if I sell the goods, I will receive the money in the future date. These are all called as a credit transaction. Okay, so in the cash book, all the cash transactions we are going to enter. Last one we have a journal proper. In the journal proper, any transaction which we are not recording in these five. What all those five subsidiary book? Purchase book, purchase return book, sales return book, and a cash book. Any transaction which we are not recording in these five books, those transactions we are going to record in the journal proper. Okay, all these are just the basics. In detail, all these practical problems we are going to discuss in the future. Okay, so this is the journal or a subsidiary. So we discussed about three steps of accounting. First step is identifying, then measuring, then recording. Next we have a classifying. Classifying means here classifying the entries in similar nature of a subsidiary book. That's what we discussed in a subsidiary book. Okay, so here different nature of the similar nature of a subsidiary book means all the purchase transactions we are recording in a purchase book, all the sales transactions we are recording in a sales book, all the cash transactions we are recording in the cash book. Like this, the business transactions has to be separate as per the similar nature. Then once it is separated, then we have to record in that respective subsidiary book. That is a classifying. So identifying, first step of accounting, measuring, second step of accounting, recording, third step of accounting, classifying, fourth step of accounting, and the fifth one we have a summarizing. Summarizing means preparation of information as a financial statement, or we can say presentation of information as a financial statement. So financial statement means financial statement is simple. By knowing or by understanding the financial statement, we will get to know whether a firm is earning a profit or it is suffering the loss. When we can prepare a financial statements? Remember, financial statements of a sole proprietor. Sole proprietor means individual proprietor, only single person. He is whole and sole responsible for complete profit or loss. That is a sole proprietor. So financial statement of a sole proprietors includes trading account, profit and loss account, and the balance sheet. When can we prepare this? When we know how to prepare a journal entries. Okay, from the journal entries we are preparing the trading account. From the trading account we are preparing the trial balance. Then we have different processes. We have a fifth step of accounting, that is a summarizing. Summarizing means what here? Presentation of information as a financial statement. So financial statement means we will prepare a trading account, we will prepare a profit and loss account, and we will prepare the balance sheet. Why we are going to prepare this? To understand whether the firm is earning a profit or it is incurring a loss. To understand that, we are going to prepare a financial statement. summarizing. All the subsidiary books collectively we will summarize and prepare a financial statement. Once we prepare a financial statement, then only we will get to know whether the firm is earning a profit or it is incurring a loss. That is the fifth step of accounting. Identifying, measuring, recording, classifying, summarizing. And the sixth is what? Analysis and interpretation. Analysis and interpretation to make the meaningful judgment. What is analysis? Analysis means by understanding the financial statement, we are going to analyze how much profit the firm has made or how much loss if the firm is incurring. So we are going to analyze that. If the firm is incurring a loss, we are going to analyze. So we are going to understand why we are making a loss. What is the reason for it? That we are going to analyze. And interpret. Interpret means after analysis, we need to make the proper judgment. Proper judgment. Yes, this is a reason we are going to make a loss. So after preparing the financial statement, we need to analyze and interpret them to understand where our firm is lagging the profit. If the profit is more, then even though we should analyze where we can improve better. So that is the analysis and interpretation. Next one, we will have a communication. So communication means communicate to the end users of accounting. So after preparation of accounting, company will not keep the accounts with itself. It will publish to the general public, or it will give it to the board of directors, or it will give it to the employees of the company, or it will give it to the managing directors of the company. Why the company, account department of that company is disclosing all these things? To tell to everyone that what is their potential. You might have already seen lot of the companies will publish their accounts in the newspapers. You might have heard that Infosys has made a 1,000 crores profit in the first quarter. Wipro has made a 2,000 crores in the first half of the year. Like this they will publish. Why they are going to publish? Here the reason is that general people will get to know about that company. Once the general public get to know about the company, they will start investing in that company. Okay, that is a reason companies are going to disclose the information to the end users. So end users means simple, who are using the accounts information. They are called as a end users. That may be you, or that may be me, that may be a board of directors of the same company, that may be employees of the same company, who all want to use the transactions, or who all want to use the accounting transactions. They are all called as a end users of the accounts. Okay, so these are all the 7 different steps of accounting, that is identifying, measuring, recording, classifying, summarizing, analysis and interpretation, and communication. So these 7 steps is also called as the features of accounting. So meaning of accounting we already discussed. These are all called as a features of accounting. So this is the very much important theory part to understand. In the upcoming videos, we are going to discuss about a very important topics, completely theory parts now. So in the next videos, we are going to discuss about a basic terms of accounting. After that, we are going to discuss about a basic concepts of accounting. After that, we are going to discuss about a system of accounting. After that, we are going to start with the practicals. Remember, to solve the practical problems of accounting, you should be thorough with the theory part. Don't skip the video any moment, because if you are perfect with the theory part, then only you can solve the practical part of the accounting. So hope you understood today's concept. If you are not able to understand, since I am a new to you people, you may have some problems which is facing with me. So please suggest me, or please inform me what is the problem you are facing, so that, or what is your doubt, so that I can clarify all your doubt. I can clarify all the doubts. I can even solve the problem if anything you are facing from my accounting classes. So we'll see you in the next video with the topic of basic terms of accounting. Thank you, students.